Welcome to the module on financial crisis. What do we mean by the term financial crisis? A financial crisis basically refers to a state of affairs when the multiple financial markets actually collapse and ending in a total meltdown of the financial system, which also leads to the collapse of international monetary system. So with a financial crisis, we mean it occurs when multiple financial markets or financial intermediaries cease functioning or function only erratically or inefficiently. That means the financial markets basically go without any monitoring, they cannot be controlled, and whatever be the policy instruments being implemented, financial markets do not respond adequately and thereby result to an inefficient operations. Moreover, we say that this financial crisis can be a non-systemic crisis which can start with one markets, but it has a contagion effect and it spreads over all other markets across the globe and thereby leading to a loan crisis or a saving crisis. So when we talk about a systemic crisis, then it involves all the financial system to the extent as it has already been done in the history of 1930s of Great Depression or very recently of 2008-2009 financial meltdown. So both of these crises have originated with mainly the bankruptcy, where there is an acute shortage of the liquidity which led to the collapsing of the system and thereby how the financial markets have stopped functioning. And this is also because of enormous size of the financial markets which are in operations. Now we move on to highlight on the causes of the crisis. So the causes of the crisis can be illustrated in terms of increase in uncertainty. This uncertainty refers to the random factors which may be responsible for creation of the crisis, increase in the interest rates, which is responsible mainly to the rise in the cost of borrowing, government fiscal problems that's related to the tax, that relates to the deficit and the loans, balance sheet deterioration. This is because when the profit and the loss statements, when the losses are ever increasing and it's very difficult to correct the balance sheet, banking problems and panics. This is because of loss in the business confidence or the investors' confidence, and thereby the banking problems originate and the panics crop in. This basically refers to the illustration of each of the crises responsible in this case. So one of the causes are taken up like the increase in the uncertainty. So whenever we talk about increase in uncertainty, we mainly refer that this refers to the role of expectations. Because whenever a business model or any kind of international trade that needs to get propagated, then definitely there is a component of future expectations. So we observe that whenever the companies cannot plan for the future and when the investors feel that they cannot estimate the corporate savings, they tend to play safe. That means under that point of time, for the short run they ignore all kind of abnormalities in the market and they look at a short run success. But this short run success does not yield any returns in the long run because it is highly unsustainable. So as a result of that, they hold cash of investing in a new factory or equipment and thereby the aggregate economic activity gets shattered. So the increase in uncertainty becomes one of the major crises or one of the major causes of the crisis. Secondly, we refer to increase in the interest rates. So whenever the interest rate comes up on the rise, which may be because of the cost of inflation, then we basically refer to the cost of borrowing is on the rise. So this cost of borrowing is basically referring to the concept of the projects which are not done. And this basically refers to the GDP gets affected. Moreover, we observe that the higher interest rate also results to the discouraging of the borrowers, because these borrowers get demotivated or they're distracted in the process and thereby they actually alter their investment decisions. This also refers to one of the particular cause of the crisis, which refers to the government's fiscal problems. So fiscal problems is when the government expend more that they take in taxes and the other revenues they have to borrow. So more they borrow, they find it harder to service their loans, and that increases the market price of the bonds. So the market price of the bonds get affected whenever the loans are to be serviced or when the borrowing issue comes in. So the balance sheet of the firms also gets affected in the process, and because of this results to exchange rate crisis, and the investors feel a kind of a bankruptcy either in the local currency which they does not outfit. So fiscal problems have a spillover effect either in the external market or in the balance sheet of the firms. This also refers to one of the most pronounced factor responsible for most of the financial crisis is the deterioration in the balance sheet. So whenever a firm's balance sheet deteriorates, its net worth falls. And because of this fall, the value of the liabilities are on the rise, the stock market becomes more volatile, and thereby asymmetric information emerge. That is how the uncertainty crops in. So the company will be at stake because it has to take a large number of risk, and thereby adverse selection crops in. This also results to the issues when there is a rise in the moral hazard. It grows more likely, which in turn makes the company at stake. So basically any kind of deterioration in the balance sheet makes the company to be more vulnerable towards any outcome of the crisis, and thereby the moral hazard becomes more and more prominent as it engages on the activities which are riskier due to the deterioration in the balance sheet. This also refers to one of the most important factor, which may be qualitative at times, is the banking problems and the panics, because it affects the investors' confidence. So whenever we look after, the banks often owe each other, and if the big bank owes more to the smaller banks and the smaller banks are becoming the defaulters, then it is seen that the big banks actually go for this kind of bankruptcy. So failure of these banks may induce the holders of the banking to run a bank, to pull out the funds, and as a result of that the bankruptcy crops in. So these banking problems and the panics are very much miserable in this stake, which thereby result to the outcome of the crisis. Hence we take up the two questions in this regard. Now we move on to understand the foundation of any sort of financial crisis, because these basically emerge in the global market where the trade and the financial flows get affected, and so that is conceptually called the concept of an asset bubble. So what is an asset bubble? So an asset bubbles are those which looks after the increase in the valuation of some asset, like any sort of derivatives like bonds, any kind of commodity market which takes care of cotton, gold, even oil, or even some cosmetic product that is tulip, or real estate, which basically goes on some kind of fundamentals. So this is basically an asset bubble which takes care of. Whenever we consider any such combination of asset bubble, also it refers to the low interest rate. So this can be referred to some combination of low interest rate which may induce excessive borrowing, particularly the purchase of asset, particularly the purchase of property asset like the housing bubble, as it has erupted in the US financial markets because the housing prices became more and more cheaper. So as a result of that, increase in the demand for the asset comes in and the bubbles are becoming created. This basically refers to some kind of asset bubble in this case which erupts and thereby collapse of the international financial system. This basically also refers to the reflections of the crisis. So when we look at the reflections of the crisis, we look at the financial panics. So what are those? A financial panic occurs when the leveraged financial intermediaries and other investors sell assets quickly. So that means in order to come up from the debt, they want to sell their asset and they want to convert their funds into cash, and at that point of time, this kind of bubble or a panic gets created. Lenders call loans or they want for repayment when interest rate is on the rise and the value of the collateral bond is on the fall. So this basically refers to the sinking of the loans and thereby the borrower is at his disadvantage. So these are very much normal in everyday business, because whenever a panic comes in or reflections of panic are observed, then this is how the asset bubble bursts and thereby the financial panic becomes persistent. This also refers to the bubbles which are bound to die but nobody knows in advance. Because this bubble will not stay for a long, but the initial panic it creates, it actually erupts or disrupts the entire financial economy, international trade institutions and the international monetary system. A burst is sometimes triggered by an obvious shock, which may be due to the natural catastrophe or which may be due to any important company which basically crashes. So that also becomes one of evident symptom of a crash. During a panic, everybody sells the assets and thereby the selling becomes a habit where the housing prices keep on dropping and selling of the assets become profitable to them. So these financial panics are also being reflected invariably in other leverage forms, like they want to meet the call and they repay their loans. Banks and the other intermediaries or the lenders also suffered the default. So these lenders can be other bank depositors, holders of the commercial paper. All of them become trustworthy, but at that point of time, they actually go for mistrust and the lack of confidence crops in. Asymmetric information, where the borrower or a lender are not having a complete level of information among themselves. This also makes the lenders to restrict the credit and thereby more and more outcome of the trade. Basically, we refer to this question that what are the reflections of financial panics? Because financial panics are basically the indication or they are actually being observed at the verge of the crisis. So firstly, bursting of the asset bubble. Secondly, the loan repayment. Thirdly, the lack of confidence among the investors. Possibility of defaulters come up. There is an asymmetric information that crops in, and definitely the market uncertainty, because market uncertainty becomes very much volatile. This boils down to the protectionism or any kind of remedial solution which can be offered by the apex bank or the central bank, which also will look after fostering any kind of trade adjustments in this process. So this comes to the role of the central bank. So if any kind of financial panics come in, which often create an havoc on the real economy by reducing the volume of the loans, insurance gets contracted, and other financial products become beneficial. So the central bank role comes in place, which can intervene and can check the system. So this in turn makes the firms reduce output and employment. This also refers to the saying that the lenders of the last resort also try to stop the panics, deleveraging the liquidity, and thereby attempt to gain the investors' confidence. So the central bank tries to gain the investors' confidence, thereby when reducing the financial system and thereby gaining the investors' boost and potential in this regard. Hereby we consider the role of the central bank, how it can intervene and take care of this situation. So central bank basically add on the liquidity into the system, because most of the crises actually suffer from huge liquidity crunch. So this can be done by increasing the money supply, adoption of expansionary monetary policy, also reducing the interest rate and making the loans to worthy borrowers, and thereby they can get back to their normal sources of external finance. Moreover, the central bank also tries to restore the investors' confidence. And in the restoration of the investors' confidence, they will try to make a kind of an adjustment in the overall health of the economy or the financial system, and thereby make beneficial to the investors. So central bank basically looks into how liquidity can be injected to the economy and thereby can restore the confidence. Moreover, the most common form of the central bank in this intervention is referred as European Central Bank ECB or Federal Reserve as they take up this responsibility. International Monetary Fund is basically one of the most important organization which also takes up as international lender of the last resort during the time of any kind of balance of payment misadjustments and any kind of correction wherever it is needed. Because it looks into some kind of boosting the financial health of the country or of the member nations whenever they have any kind of crisis arising out of debt or arising out of currency management or any kind of monetary crisis. So thereby we invite a question on what is the role of the central bank to address the financial panics. So the lenders of the last resort try to stop the panics, and they can do by deleveraging, adding liquidity to the financial system, and in a way they can restore the investors' confidence. Moreover, this can be done by increasing the level of money supply, making the loans worthy to the borrowers so that they can access to the external finance which is being needed. Now we come up to some kind of bailouts which occurred to some of the companies or the banks in the sector and also who participate in the trade, and what are its consequences. Firstly, central bank provides liquidity loans and confidence. So this can be done to face the temporary solution or the problems which are arising because of the crisis. Moreover, bailouts restore losses suffered by one or more economic agents, and this can be done with the taxpayers' money. Because this is basically done how the public money or the revenue can be utilized for channelizing these funds. Bailouts are considered to be controversial for some of the theoreticians and also to some school of thought because they increase the possibility of moral hazard. This makes people to be more and more less risky, and as a result of that people will become more and more risk lover because they know that bailout is the solution, so they cannot manage the funds, or they will tend to manage the funds inefficiently. So as a result of that they will encounter difficulties. Next we come on to that if the lender of the last resort cannot stop the formation of any kind of bubble, then bailouts is an effective way which can actually mitigate the reflection of the crisis, and central bank also looks into the mechanism effectively. So that is how the bailout and the consequences can be interlinked with each other. Moreover, when we look after the reflections of the bailouts, then we can take up a question on this regard that what are the reflections of bailouts. So bailouts, by contrast, they basically restore the losses suffered by one or more economic agents, and basically these are done with the public money or the taxpayers' money, and they act as an effective channel to mitigate the reflections of the crisis. And these crises are having more magnified and intensified in the process. Now we give an example of the crisis of 2008 and how these reflections are being basically observed in the real picture. So the most recent financial crisis began in 2007, which refers to subprime mortgages, and that makes the loans to be more risky to the borrowers, particularly to the homeowners who have started buying the housing prices or started investing in the housing properties. So in 2008, the failure of several major financial service companies stand out, and the most severe had been the financial meltdown since the Great Depression of 1930s. So the trouble began with the major housing bubble, the asset bubble which erupted. Mortgages became easier to obtain, and as a result of that, substantial percentage of home loans are coming up as a down payment. So as a matter of fact, the crisis of 2008 became more and more evident because of the continuous bankruptcy, which was like a contagion effect among all the borrowers, and ultimately the entire globe was under a kind of liquidity crunch. So in this particular module, we basically look after the concept of financial crisis, about the multiple financial markets, how they erupt together, and how basically they lead to the failure of the international monetary system, which has its reflections across the globe, particularly in the dimensions of trade, in the dimensions of exchange rate, and making the financial market to be more and more volatile. Secondly, the causes of crisis are being underlined. Mainly the causes of crisis can be due to the government problems, can be due to the fiscal issues, and also due to the mismanagement in the external sector. The concept of asset bubble have come up when the housing bubble became more and more larger and it bursted, and thereby the asset pricing came up. Financial panics are also reflected in this regard in terms of the qualitative factors. Like it affects the boosters' confidence, the boosters' market, basically the investors' market gets affected, and financial panics are also reflected in the liquidity crunch as it occurs, because they started selling their prices or selling their assets in order to get rid of this crisis. The expiration of the bailout can be one of the option or the remedy to overcome the crisis, but this has a critics because majority of the critics argue that this will lead to more and more moral hazard, because people will have a tendency not to have a more secured about their asset. They will want to play with their asset in a riskier manner because the solution of bailout is possible. The 2008 financial crisis was one of the largest financial crises across the globe as of now on recent times after Great Depression, because it led to the outburst of an asset price or a housing price when it busted like a bubble and erupted. And that is where the collapse of the Lehman Brothers, where all the economies which are linked in a global chain under the globalization network all got affected, might be more or lesser. So India was also not an exception, but India could recover from the crisis because of following the dynamics of the Keynesian model. But however, crisis has come up in Indian markets, which has affected through the stock markets, financial flows, and the exchange rate volatility. So as a result, financial crisis can take up a major dimension across the globe, which may erupt from the liquidity shortage and can spread out and or can have a contagion effect across the different parts of the globe. And that results to the rise in the interest rates, that will result to all kind of problems with the mismanagement of the funds and making the risks to be more and more pronounced. This calls for the intervention of the central bank or any kind of monitoring authority at the apex level to look after and also at the same time make the individuals cautious or the globe cautious about the verge of any crisis. So the financial crisis has also been reflected in the domain of the exchange rate crisis, because whenever we look after the exchange rate crisis, this also refers to some kind of volatility in the exchange rate, which can have an outcome in the banking policies. So financial crisis may have its origin on the liquidity crunch, but exchange crises also have come up in the process. Moreover, it is seen that when I talk about the asset bubble or any kind of bubble which is created, which can be due to any kind of mismanagement of the funds, this can also be due to the mutual funds or the derivatives which are more volatile in the market, and thereby the asset creation takes up. Financial panics are also reflected in the pricing of the stocks, because the stock prices may fall, the mutual funds can become more and more volatile, and financial panics will become more visible. This also refers to some kind of bailouts or some kind of options which are possible. But it is seen that financial crisis will have its tentacles all over the globe. Moreover, it will affect the operations of the MNCs, where the globalized chain network is linked. It may lead to the fall in the jobs, particularly in the high-end services, or the services were greatly linked with the technological innovations because of FDI or technology transfer. Those kind of services will be hardly hit because of this financial crisis, where there will be liquidity shortage. It will be further reflected in the flows of financial portfolio investment, unlike the foreign direct investment. Though the foreign direct investment flows will be affected, but the financial portfolio investment will be hardly affected because there will be more and more withdrawn of the funds from the market. And this withdrawn of the funds will be by the profitable nations who are basically the most lucrative economies of the globe. And they will try to withdraw their funds and making the market to be more volatile. This also results to the issue that this asset bubble will create, and this will basically spread out. So in this juncture, it is very much evident for the international institutions like the World Bank or the IMF to come up any kind of loans or any kind of monetary compensation or cooperation to protect the economies from collapsing on a case-to-case basis. Because it is seen with the advent of balance of payment crisis, these institutions come up with a structural adjustment program as its remedial solution. But with the crisis of financial crisis, there should be more and more advent in this order. So this basically looks after a kind of an organization to set up which can look after protecting the economy from all these kind of bubbles and thereby make a long term to be sustainable. Moreover, it is evident that any kind of crisis will be transmitted across the globe through the globalized economies, and thereby the economy will become more and more volatile. And this also refers to how this asset bubble can spread to every corner of the globe. And hence, monetary policy and the fiscal policy must work hand in hand in this regard.